Welcome to Cyclone Finance. By TI, today we're going on a journey through the invisible yet all-powerful world of finance. From the birth of money to the digital revolution, from Wall Street to your wallet, we'll uncover how finance governs not just economies, but lives, dreams, and destinies. The air we breathe but cannot see money. It's something you think about every day. You work for it. You save it. You worry about it. Yet most of us don't really understand it. We use it like we use air, constantly, thoughtlessly, and with complete dependence. But where did money come from? Why does it have value? Who controls it? And why does it seem like it's always slipping through our fingers? Finance is not just about numbers. It's about power, decisions, inequality, and opportunity. It shapes how we live, what we can do, and even how long we live. Today, we peel back the curtain and look inside. The origins of money, trust in paper and gold. In the beginning, there was no money. Early humans traded goods, a cow for grain, tools for meat. But bartering had limitations. You couldn't always find someone who had what you wanted and wanted what you had. This gave birth to the idea of a universal medium of exchange, money. The earliest money wasn't paper. It was shells, salt, metal. Gold and silver became dominant because they were rare, durable, and universally desired. But even then, money had value not because of the metal itself, but because of trust. Trust that others would accept it in exchange for goods. Eventually, paper notes emerged. At first, they represented gold stored in vaults. But over time, people stopped redeeming them for metal. The paper itself became money. Why? Because the government said so. This is what we now call fiat currency. Money that has value because we believe in it. Because laws say it must be accepted. The story of money is, at its core, a story about unbelief. The birth of modern banking, risk, leverage, and control. As societies grew, carrying gold or cash became impractical. People needed a place to store their wealth safely. Banks were born. The earliest banks in Italy and the Middle East didn't just store money, they lent it. This was revolutionary. Banking allowed capital to move. Instead of sitting idle, money could be used to fund trade, build infrastructure, and fuel economic growth. But it also introduced risk. When banks lend more than they have, they operate on a system called fractional reserve banking. They keep a small portion of deposits and lend out the rest. This works well until too many people want their money back at once. Banks became powerful, not just financially, but politically. They could fund kings and wars, and they were often the first institutions to be bailed out when economies crashed. Why? Because if banks fall, the whole economy trembles. This is where the line between public and private interest began to blur. The rise of capitalism, growth at all costs. In the 18th century, something extraordinary happened. The Industrial Revolution. Machines replaced hands. Factories replaced farms. And with this transformation came the rise of the capitalism, an economic system driven by private ownership and profit. Capitalism created immense wealth. It also created immense inequality. Those who owned capital, land, factories, money, grew richer. Those who didn't worked harder just to survive. But capitalism also incentivized innovation. Competition forced businesses to improve. Consumers got better products at lower prices. And global trade exploded. Finance was the fuel of capitalism. Investors funded companies. Companies went public. Stock markets became arenas where fortunes were made and lost in a single day. But at what cost? Capitalism, when unregulated, can become exploitative. It can prioritize profit over people, growth over sustainability, and shareholders over society. Finance became both the engine of prosperity and a source of deep instability. The stock market and financial instruments. The casino of capital. Picture the stock market. Rows of screens, fast-talking traders, numbers flying. But what are stocks? In simple terms, a stock is a piece of a company. When you buy it, you own a part of the business. If the company does well, your investment grows. But the modern financial world is much more complex. We now have derivatives, futures, options, short selling, leveraged ETFs, tools that few people fully understand. Many of these instruments are not investments, they are bets. Financial institutions gamble on the future price of oil, interest rates, or mortgage defaults. These bets can be profitable, but also devastating. The 2008 financial crisis was triggered by such instruments. Mortgage-backed securities, collateralized debt obligations, credit default swaps. In pursuit of short-term profit, banks bundled risky loans and sold them as safe, When the bubble burst, the damage spread across the globe. Finance became a casino, but one where the house was too big to fail. Central banks and monetary policy. The hidden hand. Most people don't know who runs their central bank, but these institutions have immense power. They control interest rates, print money, and shape the economy. In the US, it's the Federal Reserve. In Europe, the European Central Bank. Their decisions ripple through every sector: housing, employment, inflation. When times are tough, central banks lower interest rates to encourage borrowing and spending. When inflation rises, they raise rates to cool the economy. They are supposed to be neutral, data-driven, and independent. But are they? Critics argue that central banks serve the interests of the financial elite, that low interest rates inflate asset bubbles, that money printing devalues savings, that their tools, once meant for emergencies, have become permanent. We don't vote for central bankers, yet they decide how cheap money is. They decide the value of your mortgage, your savings account, and your future. Inflation, recessions, and financial crises, the boom-bust cycle. Why does the economy seem to always be in crisis? Boom, bust, recover, repeat. It's a pattern older than capitalism itself. When times are good, optimism reigns. Businesses expand, people borrow, asset prices rise. But eventually, excess builds, bubbles form. And then something bursts. A housing market, a tech bubble, a debt crisis. Panic spreads. Recession hits. Jobs are lost. Families suffer. Inflation is another silent killer. It erodes the purchasing power of your money. Suddenly, $100 buys less. Wages lag behind. Savings dwindle. Governments respond with stimulus, bailouts, rate cuts. Sometimes it works. Sometimes it merely postpones the inevitable. Understanding these cycles isn't just academic. It helps you prepare, protect, and even prosper during downturns. Personal finance and wealth inequality. The divide. Let's bring this home. What does all this mean for you? Personal finance is the intersection of macroeconomics and your daily life. It's budgeting, saving, investing, debt, and financial literacy. It's how you survive and thrive in the system. But here's the truth. The system isn't fair. The rich have access to better information, better advisors, and better tools. They buy assets that appreciate. The poor rent liabilities that depreciate. The wealthy use debt to build wealth. The poor use debt to survive. Wealth inequality is not just a number. It's a trap. It means fewer opportunities, worse education, poorer health, and diminished life expectancy. Financial literacy is your shield. Budgeting is your sword. Investing is your pathway out, but you must act. No one is coming to rescue you. The psychology of money. Emotions, biases, and behavior. Money isn't logical. It's emotional. It's tied to our fears, our hopes, our identity. We are not rational actors. We are driven by greed, fear, envy, and pride. We chase trends. We panic during crashes. We compare ourselves to neighbors, influencers, billionaires. This is where financial psychology comes in. Understanding how your brain works around money is crucial. Biases like loss aversion, anchoring, and herd behavior cost people millions. Behavior trumps knowledge. You don't need to be a financial genius. You need discipline, patience, humility. The greatest investors in history, like Warren Buffett, succeeded not because they timed the market, but because they mastered themselves. The future of finance, crypto, AI, and the digital economy. The world is changing fast. Cryptocurrencies promise decentralization, anonymity, and freedom. Bitcoin, Ethereum, blockchain, these words weren't in our vocabulary 15 years ago. Now they challenge the entire banking system. Artificial intelligence is transforming investing. Robo-advisors, algorithmic trading, data-driven decisions. Finance is no longer human. It's machine-led. The digital economy is here. Mobile payments, digital wallets, tokenized assets. Cash is dying. Banks are closing. Borders are meaningless. But with this revolution comes risk. Hacks, scams, volatility. The Wild West of finance is back, and it's online. The future is uncertain, but it is also full of opportunity for those who are prepared. Conclusion. The power of understanding. Finance is not just a topic for economists or billionaires. It's for everyone. Because whether you like it or not, the system affects you. It decides how much your food costs, whether you can buy a home, when you can retire. To understand finance is to reclaim power. Power over your choices. Power over your future. Don't be a pawn in a system you don't understand. Be a player. Be a strategist. Be aware. Subscribe to Cyclone Finance for more deep dives into the forces shaping your life. And remember, knowledge isn't just power. In finance, it's profit.